The conclusion of Wednesday's FOMC meeting weighing on gold and silver as they retreat to 2.5-year lows. We don't have Bernanke today, but we do have James Grant. He's the man that Ron Paul would like to see as the next Fed chairman. He's also the editor of the Grant's Interest Rate Observer, and he joins me on the line. Jim, can you help make sense of what's happening to the metals today?
Interest rates in North America and in most of the world have been falling since 1981. That's a 32-odd year a bull market in bonds, and a powerful force for memory, for expectations, for unthinking reflex. People have expected rates to fall. They have gotten comfortable with that idea, and now it appears that it's beginning to reverse. So gold now has a little bit of competition in the form of slightly higher interest rates, and the fear of substantially higher interest rates. And I think that is principally what's behind the sell-off.
Jim, I know you're no fan of the Federal Reserve, but did you pay attention to what came out of the meeting?
Oh, sure. I mean, of course, we have to. The chairman said that America's economy is strong enough to bear something like non-zero interest rates, something a little bit greater than nothing. And I think a visitor from outer space would be mystified by the panic these words have engendered. But, we are on the PhD standard. We have collectively given almost complete discretion to the visibly dysfunctional econometric models that our monetary mandarins deploy. And there's no real telling what they're going to do next. They mean well, but they don't often do well. And I think markets are in a tizzy about what might happen.
Realistically, Jim, can money printing stop?
Well, I think it should stop. I think that it will not stop. The chairman said that the creation of new money with which to buy Treasury securities and mortgage-backed securities will continue into 1914 and zero interest rates beyond that. It's a mystery to me why, if this economy is in fact on the mend, it continues to need either heroin or methadone. But that was the import of the message yesterday, that it continues to need it.
Given Thursday's events, Jim, are you still bullish on gold long term?
Yes, I wish I had was a little more nimble for the past $600 or so per ounce, but I am bullish on gold. I believe that the price of gold is the reciprocal of the world's confidence in the institution of managed currencies and in the judgment of the likes of Bernanke, PhD. And to the extent the system and the judgments are defective, which I think they are, the world's confidence ought to be shaken, and the world ought to hold a better view of gold. Now, we gold bulls / gold bugs ought not to forget that we ought to like it more as the price goes lower, not less. And the trouble with gold, as everyone listening to this knows, certainly, is that it earns nothing and yields nothing, and there's no conference call, and there's no management to blame. And it is, to a degree, a price without an underlying stream of substance. So the substance we supply through imagination and through forecasting and through analysis of monetary institutions. And that gives us confidence on the upside, but it doesn't give us much confidence on the downside.
Jim, when you say the world ought to have a better view of gold, what do you mean by that?
Gold is money. It is that legacy form of money that the monetary mandarins the world over, cannot materialize on a computer screen. It is not Bitcoin. It is to me the ultimate source of monetary value, and the one and only monetary asset that has universal currency. And also, it is I think the heir ultimately to I believe, the certain failure of the monetary arrangements in place. Now, that is a lovely point of view to hold, and I wish it upon the world, but the world doesn't have to accept it just because I believe it.
So in your opinion, Jim, what should be the fair market value of gold?
Well, see, that's just it. There is no fair value price. There's no book value. There's no equilibrium. There is a trend. There is an arc of monetary events. Okay. It seems to me. And if you believe, as I believe, that the arc of monetary events is pointing towards the ultimate failure of the system in place, then you would put a much higher value on gold, certainly than the price to which it has plummeted today. So count me discouraged, but very, very bullish indeed for the long term.
And do you have a price projection?
Absolutely not. Higher.
Higher. Okay, so Jim, finally, we've had Congressman Ron Paul, multiple times on the show, and he said that if he had to choose a Fed chairman, obviously he'd rather the Fed doesn't exist, but if he had to choose a chairman, it would be you.
If I were forced to choose a president, it would be Dr. Paul.
So Jim, if you were chairman, what would you do differently than Ben Bernanke?
I would first level with the public. I would, using the English language, I would explain that I am making it up as I go along. I'm not speaking as if I were the chairman, and that we are going to institute capitalism in banking to start with. That is to say, the owners will be responsible for the solvency of the banks, not the taxpayers. And I would say that we are going to embark on a long-term project to re-anchor the dollar in gold bullion at a price to be determined by the marketplace, and that this will in the end be hugely bullish for enterprise. And people out there, don't worry, it's not going to be deflationary, it's not going to be inflationary, it is going to be terrific. That's my speech.
And on that note, we'll conclude. Thank you, Jim.
And my pleasure.
And thanks for watching our continuous coverage here on Kitco.com. You can follow this conversation at Daniela Camboni. Thanks for watching.